Hi everyone, and welcome to another episode of the HeelanHub Podcast, the show for small business owners. I'm Dan Heelan, and in today's extreme heat in the UK, I'm going to be talking to you about limited company pay. You as an owner, shareholder, director of a UK limited company. As always on this show, we're talking about small businesses. We're not talking about large PLCs or other quirky things. This is your normal generic example. As always, I also want to say this is education, not advice. So take it with a pinch of salt and just think, is this for me? Go do your own research, go speak to your own professional people about what might be possible. But I just want you to take some key concepts from this. And the reason I wanted to do this one on the podcast is because I think if you've been in business for a while, or even if you're just starting out, you'll have done your research and you'll realize, look, there's this thing that people do where they have some salary and they have some dividends from their limited company. And in this episode, it is going to be pretty limited company sort of centric. But if you're a sole trader, it might be worth you listening so you can see the kind of things you could do if you were to decide to go limited, especially with Making Tax Digital coming. Maybe that's something you want to do. Now, and you might think, well, okay, well, I know about lower salary, higher dividends. That's what I've heard is the thing. So let's just presume you know that kind of concept. And if you don't, absolutely just go back a few podcast episodes, or we'll have already talked about it this tax year already, talking about the best with bunny ears salary to use. In this one, I want to take that a step further, and I want to talk to you about my framework around how I view tax deductions and what's worked for me and my clients, and tell you a little bit of backstory as well about something that happened to me years ago and how I kind of got into this thought process and mindset, and I suppose the journey I went on. So let's get straight into it. So I'm going to show you an example of how we effectively get 115 grand taken out of a company. And I say show you, if you're on the YouTube channel, I might be waving my hands around a bit, but if you're listening to this in out on a run or at the gym or wherever else, I'm going to try and explain it as best I can in audio. But and that brings me to a point to say that we do chuck these out on YouTube at the moment. So if you just stick in Google the HeelanHub Podcast on YouTube, you'll find us there. That's different to our main channel at Heelan Associates, where we do loads of guides. I think there's 361 videos at the time of recording this up there on all sorts of things around small business, tax, accountancy, and business. So go and check those out. But if you want to interact with the show, you can go in there and drop in the comments, and I'll check those at least once a week, if not more often, and I can reply and talk to you there. And it's cool just to be able to interact with people, because we know from the numbers loads of you listen, but it's one of the ones where it's weird because I literally record talking to a mic and a camera, and we don't see anyone. Whereas with the YouTube channel, the main YouTube channel, with all the views and subscribers that gets, we get to interact more often. So if you do have any questions or you just want to chat, go in there and talk to us. I'd love to hear from you. So then let's talk then about my journey I went on. So I vividly remember going back years ago and thinking, when I first become involved with a limited company, and thinking, okay, I know I need to pay myself. I'd come out of employment. I'd had some side hustles on the go. So I kind of knew by now about side hustles and how they worked. But coming in, transitioning into a limited company, I thought I just want to kind of replicate my pay. So I thought, what should I do? Well, I figured out how you set up a payroll and understood all that, and how to run a payroll. How could I run a payroll? So I went and did that, figured that out, and I wanted, I think, 1,500 quid at the time. So then I was like, okay, I'm getting £1,500 every month. Though, as a result, I had to deduct, and remember, this is like nearly 20 years ago, so 1,500 quid had quite a bit of tax attached to it. So you had to deduct your tax and national insurance and pay it over, because my limited company was employing me, and then I would get the rest. Now, the impact of that on my cash flow as a company was that I had to take it and hand it over to the revenue each month. And I was thinking, this is killing my cash. And I was talking to other business owners and other accountants and people, and thinking, well, there must be a better way to do this. And at this point, I wasn't a trained accountant. I was in business. I had a very good interest in tax, but I wasn't a trained accountant at this point. So I didn't know about these things. So I spent hours, and I mean hours, deep diving. Back then, it would have been on forums. Now, the closest we've got to a forum is probably Reddit. But I mean, just think like that. But I think there was all these forums, years worth of threads of people discussing it, and professionals. And back then, I think, honestly, there was more of a community feel to this type of thing. There was a genuine, interested community in this area. And you'd go in and you could discuss with people, and people would tell you what's possible. And I just went massively deep on it and figured out that actually I probably should be paying myself dividends or salary. But then I went through that thing of, well, okay, I don't technically know how to do this. I worry that it's not right for me. I'm worrying about getting it right, and I just couldn't seem to figure it out. I could figure out roughly what I needed to do, but just not specifically. But I knew that if I wanted to grow my business, I needed to make sure that I stopped this cash flow problem of having the fact that I was parting with this cash every month. Eventually, I figured it out, and long story, as most of you know who've been listening to the podcast for a while, I retrained later in life, become an accountant. I've been doing this for 18 odd years, and it was these kind of things that really kind of got me interested in it. Is I know there's a better way, and I know that it's costing me money not knowing, and that bugs me. everybody else in employment and everything else just gets their tax applied, and they're fairly, if you want to use the word fairly, but if you're in employment, you should get roughly the same taxes as everybody else in the same similar situation. With self-employment and business owners, unless you know this stuff, you're going to pay more tax, or you're risking the fact that you've done it wrong and you're going to get fined later. Maybe you don't sleep very well, that kind of stuff. And I just remember these kind of feelings. So anyway, what I'm hoping in this podcast is to run you through the fact that it's going to save you loads and loads of hours of doing the same thing by me telling you my kind of philosophy on this, and I suppose what I learned from it, but also taking you beyond this salary and dividends. So I figured out very quickly from there, okay, low salary, high dividends, the amounts change per tax year, but we've been in a bit of a freeze over the last few years where not too much has changed. So now you need to really look around the edges. And me personally, I've loved always looking around those edges, but I think even more so now it's important. Now, let me take the key concept. And if you take nothing from this podcast, just think about whether the money you're spending is a you problem. And that's what I like to think about. I'm like, is this a me problem when actually I want it to be my company's problem? So let's say I'm out, I'm buying food, I have to live, I've got a mobile phone personally, these kind of things we're going to touch on, because if we can get the company to pay for those, is a massive deal over a year in a tax saving. So if you picture from your limited company point of view, you would have had paid corporation tax on the profit, to then draw the money. You've probably paid tax on those dividends we're talking about to then go and buy the thing. So 2 lots of taxation to go and buy the thing. If we switched it into the company's name, firstly, the secondary taxation of the dividend's gone. But if you could get a tax deduction on it, you've also reduced your tax bill. It's a phenomenally different picture. So, and you might think when some of the figures I'm talking about, you think, okay, that's a bit low level. But when you're in this area, low level times lots of things over a year makes a massive difference. And when you hear these people online showing their salaries, so random one before we went on the podcast, I was scrolling Instagram, having a look at some, trying to get some inspiration for something to talk about in terms of how I might frame it. And I come up across somebody who was posting their PAYE wage slips, I think about 140k, and they're showing what they received and then they're showing what they pay. And I'm like, business owner doing this, they'd be able to move some of this around so that they would get a bit more of a tax efficient thing here for the risk that they're putting in. Okay, there's no holiday pay and all the rest of it, all the other things we've talked about. But from a pure tax point of view, it's very possible to get a much better result. And it's those kind of things that I really want you to think of. So when you're thinking of this, if you take away anything from the podcast, just think, is it a me problem or is it the company's problem? If it's a me problem, can I make it the company's problem? And that's the kind of mindset I want you to get into. So let's briefly recap, I guess, on the 4 main ways to take money from the company. And I'm not going to spend hardly any time on this because I've just given you some story about how that came around for me. But we've talked about salary, dividends. The other 2 type, very commonly, you'd have had expenses. So maybe you're repaying yourself mileage or something like that for the company from a personal car that you've done some business miles on. Or you put some money in at the beginning, or you've ad hocly put some money in, and that's created what's known as a director's loan account. And you're taking that director's loan out. Now, they're the 4 main ways, the 4 most common ways that people will take money from the company. And you want to get that bit right first. So if you got that right, you're probably in good stead. Now, on top of this, you should always consider in some way, like, can I split my income? So stereotypical scenario, husband and wife in business together, being able to split salary, being able to split dividends, and maybe you've got a share structure that allows you to pay slightly different dividends if you've got slightly different taxable situations between the 2 of you, will save ridiculous amounts of money, potentially keep you child benefit and all these other things. And that's where the limited companies go into like turbo good mode, is if you can do these kind of things. But I'm going to presume in this podcast that you've done that planning. And you could do nothing else and that would still be amazing for you. And I think as accountants, we spend a lot of time in that zone. And this is the chewing the fat around the edges, trimming that down and taking you through that kind of tax efficiency funnel a bit more without getting aggressive. And I'm a big believer in that whatever you do here has to stand up to scrutiny. So sometimes in tax law, it will say one thing and you're like, yeah, that's right. But would you be comfy sitting across an accountant? And I remember sitting across a tax investigator and somebody like an officer at the revenue, the HMRC, in an investigation and telling the story of why you bought this thing and why it's wholly and exclusively for the use of business, which is a key concept. You've got to be comfy with that. So sometimes these weak answers we get given, I work for our clients, all my people work for our clients. We're going to make sure that you're protected. We don't work from the revenue, but at the same point, we're not going to let you do something silly where it's quite clearly obvious that's never going to stand up to anybody. So does it pass the BS test if we're really asking the right question? And with all these things, this is what I want you to consider, because you do not need to be super aggressive and you do not need to do just illegal things to save tax. That's not really the game here. The game is it a you problem? Let's try and make it a company problem if the tax law supports it. So that's the kind of overarching principles that we're going for here. So salary, dividend, expenses, director's loan, I presume you've got those on lock and you know what you're doing there. If not, go back a few episodes of the podcast. So I want to start with tax-free benefits. So we mentioned a few things like mobile phones. So one thing that's very possible is the company can take out a mobile phone contract in its name. And this is really important. If you've got a personal mobile, the company just paying for that is not the go-to. There's various different tax consequences to that. What you need to do is move it into a company contract. And if the company's paying for it, it can provide it to you, whether you use it wholly for business or not. There's an exemption that says, look, we just recognize the fact that you are, by the fact it's in your pocket, going to use it personally, and that's okay. So mobile phones is a big one because you'll quite often be paying quite a lot of money to use those. So that's a big one. On top of that, if we're looking at things around that we mentioned earlier, I talked about food. Now, you can have annual functions. So you, even as a sole kind of a very small business, you can have an annual function where you take yourself out for Christmas do, whatever. It doesn't have to be a Christmas do, but you get £150 per head per tax year that you can spend on those meals. So it can be spread out over multiple functions, but you've just got to not ever go over 150. It's not an allowance. It's not like if you went 151, the £1 would be taxable. It's if you do £151, the whole 151's taxable. And it's not really the tax bill that's the problem. It's the absolute pain that is the admin when you do that. So I won't go too deep into it other than just say, look, just keep under 150 head. So if you're going to do 75 on one mill and 75 on another, just bear that in mind. There are more details on this, and I've done other shows talking about annual functions. So I'm just going to give you top level tips. So that's one. The other one is something known as trivial benefits. And we've spoken about this probably before. And this is effectively super top level where the company can give you £50 gifts. So some people will use Amazon gift cards or, Costa cards or something like that, but it can't be cash, can't be linked to performance in the company. There's lots of conditions. And the revenue knew this might get abused. So there's a cap on you as a director of £300 per tax year. Now, where it's normally used is, for example, my team, they have a birthday. We want to give them a birthday present. They shouldn't be penalised because we want to buy them a birthday present. And actually the company doing a nice thing should be rewarded with a tax deduction. So it works perfectly in that scenario, but it also works for you. So there are things where you can look and think, I'm spending this money. Could this be a trivial benefit using that concept? And again, just stick in trivial benefits online and you'll see videos and blogs and podcasts that we've done talking about trivial benefits and deep diving into that. But that is absolutely something you want to do. That's about £300 a year. For most people, it's going to suit your circumstances. As always, have a look. So between that and annual functions, you think there's £450 there that you might have moved into the company's name if you could achieve it. So that's big. Now, working from home. I'm going to talk to you about some advanced tactics in a minute around working from home. But on the basics, you get £6 a week if you maintain like a home office or you work from home. And that is easily claimable for your company. And I say claimable, people often get confused with that. In a limited company, it's normally a book entry. So you say, the company owes me that money. Sometimes you might physically transfer the £6 a week. I've never met an owner that does, but you could, or you could do the annual version of that figure once a year, something like that. But otherwise, people put it in their books. If you've got an accountant, it's very normal that they will add that in for you if they're even half decent. So, but working from home will allow you to do that. And that keeps you a bit more, again, of money into your hands. So you think between those things, we're already near, £1,000 nearly towards, it depends how much you pay for your mobile, but you could be well over that. And then while we're talking of home offices, you could consider, and this one is definitely a fine line, going back to the no BS test, canteen and subsidised meals, provided at a reasonable scale, are generally allowable. So what that means is if you've got a home office and you're running a home canteen, you could supply tea, coffee, bananas, subsidised meals. In theory, you could put your lunch in there at a reasonable cost, at a reasonable scale. What this isn't is ordering Starbucks in every day or putting your McDonald's through every day. That's not subsidised canteen as far as I'm concerned and as far as the tax law is concerned that we've read. So just think about that reasonable scale. It might average out as £3.50 a day or something. One of the examples I ran for this was I just presumed, let's call it £3.50 a day. Now, that needs to be exact in expense. That's not some sort of allowance. That's just me talking about when I divided it down. That's roughly what it ended up being. But reasonable things like tea, coffee, milk, bananas, again, they add up. You might think, that doesn't sound that exciting, but we're already down the list and we're already added quite a considerable amount of stuff into here. So that one's quite big. So you should investigate that. Now, if you do happen to go to an office and you have an office, then your commuting between home and the office is normally not claimable because general commuting isn't. But there's a tiny rule that says, look, if you have to work, say, after 9 p.m. or there's some other criteria, you can pay for a taxi and you're allowed to do that about 60 times a year. 60 times a year, you're allowed to do that. So have a look and think, if I am paying taxi fares between office and home on occasion, then they might well be payable. So that is quite important. So there's a load of little ones there that are really going to add up. Now, on top of that, if we look for something a bit bigger, so what about loans? So without going too much into the detail here, and this one is absolutely fraught with danger. So I almost don't want to tell you this one, because every time I do, I meet other accountants who listen to the podcast or watch the YouTube channels. They're, why do you talk about this one? People get stuck with this. So if you're going to do this, make sure you understand the rules, speak to a professional that really understands it. But I will tell you, you can borrow up to £10,000 from your company without tax consequence. But there are various situations where you can get yourself in a real muddle with that. And there's time limits to it. And this is big. So there are time limits to it. Normally, there's a tax consequence. If you owe even £1 to your company, once you get past 9 months after your year end, there is a very real tax consequence to that balance. But for a short-term loan of £10,000 could be quite big. So you might be thinking, well, what's the point? When's that actually going to be useful? Actually, more often than you think. Example, let's say, under the current rules, about £50,000 a year can come out at very cheap tax, whether that's salary, whether that's dividend, whatever the case may be. Let's just say it stacks up really nicely. Your dividend is only 8.75% on that amount up to about 50k. When you go over that, the dividend jumps to 33 and a bit percent. That is massive difference between 8 and 33, just alone, forget the rounding. Now, if you decided then, so you'd taken all your money out, you're very close to 50k, you're getting to the year end, but you had to put your great deposit of £9,000 down on your Maldives holiday. You could either pay and take the dividend and pay the 33 odd percent tax, or knowing that maybe you were going to take less next year, you could leave it outstanding, what they call an overdrawn director's loan account, and you could potentially then deal with it into the following tax year and repay that loan by dividend. So you could you note it, you don't physically take the money and it cancels out the money you've taken. Hard concept to describe, but just I want you to know that it's possible, and that will save quite a lot of money. You could have saved considerable sums doing it. So it actually is a very commonly used tactic, but there are so many rules around that you do need to make sure that you understand them. But do know that there's a big amount there that can be done for a short period of time that can be really, really useful in the right situation. Now, talking of other big ones, pensions. Now, don't switch off, because I know pensions aren't particularly sexy to talk about, but you can do two things. The first one is providing that all of your employees, so if this is only you, it's only you, but if all of your employees are open to the same thing, you can actually the company can pay for pensions advice of up to £500. So you think about it, it's almost the company paying for your personal investment advice, because it's what pension do you want to pay into, and there's an exemption for that, so the company can pay for it. You don't have a tax problem personally. Up to £500, but it's just got to be available for all. There are some other little criteria, but that's the generic feel of it. Once you've done that, or maybe you've already got another pension or one that you've already got set up, so maybe you didn't need that, your company can make big pension contributions into your pension on your behalf without any personal tax or anything like that. It doesn't go through payroll. So there's two types of pension payment. There's your bit, your employee's contribution, and there's the company's bit, the employer's contribution. And what we're talking about here is the employer's contribution. If you made one personally, you'd have to take it from the company. You'd have to pay your dividends, and you'd already pay corporation tax on it. You paid your dividend tax and then put it into your pot. And you get a bit of a tax top up at your end. So there is a benefit to that. But the most common by far is to make a big one-off payment every year as an employer's contribution. And what that tends to do then is that is tax deductible. So it reduces your corporation tax bill in a big way. So that drops it down. It moves it into your hands and into your pension. The downside, of course, is you can't normally touch that money until your mid-50s. But if you want to put it in there, it's a ridiculously good way to reduce your corporation tax bill and move the money into your personal name. So that's really good. And that doesn't count towards those bands we were talking about. So it doesn't count towards this 50k limit of the rest of the money that you might be drawing for a year. So if you've got lots of money building up, it's a really common, good one to use. Now, I did say there's some advanced ones. So let's talk about those. We mentioned directors' loan accounts. Well, what happens if it was the other way around? If you put a load of money in at the beginning, quite commonly, someone will borrow 20, 25 grand to start their business up. They inject it into the company. The company couldn't borrow it to begin with. No one will give you any money, but you might have borrowed some money. You could potentially charge interest to your company for that. Now, and you can do that at commercial rate. And the cool thing about that is you personally, let's presume you haven't got any other interest, you could have £500 to £1,000 of interest tax-free, depending if you pay higher rate tax or, so basically is your earnings total combined under 50k or over 50k. If you're under, you're at about £1,000. There is some other allowance that I won't even get into because you have to earn so low to actually use it, but there is another allowance that allows even more. But let's just say that just this £1,000 it can work really well. So a company would get a deduction you would get it in your hands tax-free. So that could be quite good as well. The downside to it, and the reason a lot of people don't use it, is because you have to fill out quarterly returns every time, and there's penalties for missing them. And on top of that, you actually have to physically part with 20% interest to the revenue. So you have to deduct 20% interest on the payment you make to yourself and hand it over to the revenue. The mechanics of that are you normally get that money back on your personal tax return, but again, there's a cash flow thing because you've got to pay it out. So it does help. It does work. Do many people do it? Not very often. I've got a couple of clients I can think of we absolutely do this too, but it's rare just because of the paperwork hassle and whether a client wants to do it, and if they want to pay us to do it, it doesn't always work out that well. So that's definitely an option though. And on top of that, the other advanced strategy I would want to talk about is charging rent. So if you're operating from home, your company could potentially draw up a license agreement for what's known as a non-exclusive use of a room in your house. And it has to be non-exclusive because otherwise you have other tax consequences around if you go to sell your house and it was used for business and things like this. So you want to avoid that. But this non-exclusive license really helps. But you've got to put in some decent paperwork to do it. So you normally need a license agreement. And the idea is that your company then, you personally charge your company rent. So let's say it's $3,500 a year. It's got to be sort of market rate. It gets a deduction on the $3,500, reducing your corporation tax bill. You get it on your personal tax return. You're taxed on it because it's you running a rental business, but it allows you to offset some of your home costs because your proportion of your home costs, and this is where the difficulty comes. Not only do you need a license agreement that makes sense and kind of covers the tax points, but you also need then to figure out what can I apportion? But, if you've got mortgage interest, if you've got council tax, utilities, these things, there's going to be a proportion that you could offset against that. Say in this example, $3,500 that you've charged, and you're effectively getting a tax deduction on some of your home costs. So thinking about the you problem, company problem, you problem, company problem, you're making more of the you problem, although it's not necessarily a company problem in a weird roundabout way, it becomes one. It's hard to explain. There's a lot of information I've fired and I speak quickly, but hopefully you can get the idea of what potentially possible. And again, that's a relatively common strategy, but it's only when it really makes the difference. Sometimes people's costs mean it's just not worth mucking around with and the extra reporting and things like that. But in the right circumstance, absolutely, that'll work. And the more we've seen interest rates go up, the more that one becomes more popular, especially if you're renting, oddly, because the way the rules work, you don't get to deduct your entire mortgage payment. You only the interest. But if you're renting, it's more cost that's potentially deductible. So see a lot of that. So there's a couple of advanced ones, but they need to be done properly with the interest and the rent. Now, I did say to you that I would talk about examples. So let's just talk this through, and I'm going to do my best to try and explain this to you without showing it on any screens or anything. But I said about 115 grand. So there's a couple of examples. So let's use the cheaper one. Let's use about 80,000. So you could potentially draw 80,000 out by doing 12.5 grand-ish in salary. That's tax-free because you've got your personal allowance as an individual. £500 worth of dividends, user allowance. £1,000 of interest because we're going to keep you under 50k total here. Then you've got your rent at 3.5 grand. Now, in an ideal world, we try and get your expenses to match 3.5 grand as well, so that you paid no tax. If you imagine there's no profit, then 3.5 grand comes in, but your home expenses proportion is at 3.5 grand as well. Wipes that out. That means you've taken about 17.5k tax-free. That's great. Then on top of that, your company could pay you a one-off £60,000, which is kind of the annual limit for most people, in employer's contribution straight into your pension. It's going to give you a massive tax deduction of corporation tax. And then you might have, say, I don't know, £360 on your mobile phone. That's quite a cheap mobile phone, really. For a lot of people, they're paying 50, 60 quid. Your lunch at £3.50 a working day, maybe 900 quid. Your staff party at 150 quid, your trivial benefits at 300, and that all amounts up to about £79,000. And that result would have reduced your corporation tax by 19,698 in this example. So it could be really, really big. Now, the reason I say that showed at 80, if you were my client and I was looking at that, I'd be probably shouting at you to pay more tax. Because in that example, you paid zero personal tax. Zero. So you're like, why would I want to pay tax? Well, let me tell you, we mentioned this basic rate thing. So the limit of 50-ish K is not a carry forward job. It's a use it or lose it. And if you just leave it there, you'd have left money on the table. So what I would suggest in that example is if you were my client and if we were working with a client here, we'd be saying, look, you've got this band, you've got some money still, because you've only taken about 17 odd grand. You've got another 36,000 in dividends you could take out at a mere 8.75%. So we'd be saying to you, do that. That will increase your tax bill by about £3,168 roughly, but it puts another 36 grand in your pocket. So for 115 and a bit, nearly 115,500, say, you could do about 3,000 and loose, basically, of personal tax and still have reduced your company's tax bill by 19,000. Now, you might be thinking on a podcast, this is quite hard to take in, but again, I'm just trying to get your juices flowing about what might be possible. And again, caveat, you have paid a large corporation tax bill to do it, but that's absolutely there. Now, the reason I love that example is because it's something we talk to clients so often about is pay more tax for a better tax result. And again, if we go back to the concept, you might think, well, actually, why do I need to? Why would I just save the $3,000? Because what happens next year if you want to take, because you've got a lot of money in the company, because you're doing really well, obviously, and you want to take 70 grand next year because you want to do your house up with 20 grand of it, you're going to pay, if we take that 50K cheap money, you're going to do that. And then you've got another 20 grand that's going to be taxed in excess of 33%. If you had done the tax planning we were talking about and declared that extra 36 grand dividend in the last tax year, and if you do it properly, you don't actually have to take the money. It's all a paperwork exercise. It could just be sitting there owed to you later to take tax free. It just counts as being taxed in that previous tax year. You'd have saved yourself the difference between 33% and the 8%. It is massive, massive. And the amount of times I see people, as I recorded this, I was screaming at a client. I wasn't screaming, but in my head internally, and I was screaming at the previous accountant because, and to be fair to the other accountant, they weren't engaged to give any sort of tax advice. They're one of these kind of like, you give us the figures, we'll report type people. But they'd done this similar situation where the client had only got 15 grand's worth of income and he had all this money in the company and absolutely should have had and should have declared more dividend in his circumstance, because the next year he took 80,000 and paid a load of tax. And it's very, very difficult to sort out because you miss this opportunity. So this is where hopefully working with somebody professional can help do this. But if you're doing this yourself, just plan it out. If you're a geek like me and you geek out on this stuff, then absolutely go and work it out in a spreadsheet. I've had a client recently send me his spreadsheet and I was very impressed. So it's absolutely possible to do it yourself, but I do think that it's worth working with professionals if you can on that. And I would say that is a really good end to, I suppose, our examples of where I think you can carry on that tax efficient funnel and get even better at this kind of game. So hopefully that's given you some ideas. And again, main concept, is it a you problem? Is it a company problem? Can we make a you problem a company problem? If we can, we're absolutely going to be in a better place. So there we go. Food for thought. Please do let me know if you've enjoyed that tips and there was anything that you took away on that, which would be really cool. If you have enjoyed the show, make sure to subscribe via your favorite app so you don't miss an episode. You can also, if you take a few seconds, it really helps our visibility if you could review us online on whatever app you do. If you want to get started in the accounting world or you're in business at the moment and you're looking for some accounting software, we have a great deal with Xero, which for me is the market leader. And you can go to healanassociates.co.uk/Xero and get yourself a ridiculous discount at this moment in time. Helps us, helps you. Everyone's a winner, so please do that. For more business insight and tax tips and other interesting links and things like that, you can sign up to our HeelanHub Herald, which is an email that comes direct to your inbox every few weeks. If you could just go to healanassociates.co.uk and scroll around, you'll be prompted with a pop-up box. Stick your details in there and we'd love to have you on that list. On top of that, you can also, of course, hang out with us on all the social media channels. So LinkedIn, Instagram, YouTube, Facebook, Twitter, even TikTok these days. And, keep up to date with it all there. And again, we do plenty of content on all those channels around all these types of subjects. If you do want to get in touch with the podcast, you can do so at info@healanassociates.co.uk and we would love to speak to you. That's it. Have a profitable and tax efficient week and I'll see you in the next one.